Fiona Frick. She is CEO of Unigestion. Please welcome her. Fiona, I'm just going to start by asking you briefly about your organisation and what you do in the first couple of minutes, just so that we get an understanding of your perspective.
Okay, so we are a pure asset management company. We're called Unigestion. We manage around 20 billion across different asset class, mainly private equity, and then public equity and a few liquid alternatives. And we manage money for institutional clients, which is pension funds and endowment, etc., but also family offices and high net worth individuals.
And you have an interesting way of describing how the mindset has changed, really, from shareholder to stakeholder. How do you describe that?
So I think there has been, with the crisis of COVID, with the start of deglobalization now and the importance of resilience in the economy, a move from believing in the Friedman theory of the 60s that the role of a company is to serve shareholder, to a new paradigm, which is the role of a company is to serve stakeholders, and at the end, if you serve stakeholders, it will serve shareholders. And it's interesting, for example, if you look at earning calls from companies in 2018, ESG was mentioned 1% of the time. If you look at 2021, and this is worldwide, so include China and other countries, it's mentioned 20% of the time. So companies understood that in enterprise value creation is not only based on financial data, it's based also on showing that they have a business model which is resilient and showing that they are integrating this sustainable revolution which is coming. And this sustainable revolution, obviously there is an urgency with the Ukraine war, but there's also an urgency with climate change, and we can see it every day with the floods and fire we see. And it's all these business models of company that will have to transform to integrate this new reality. So shareholder to stakeholder, taking into account sustainability in the strategy of a company, changing the way a company produces, changing the way it offers a service to consumers, etc., etc.
And this really means that we have to change the way does it question, how we measure success. I worked for the BBC for 3 years in New York, and it always seemed to me, it bemused me that companies, if they missed targets, their quarterly targets or whatever, then suddenly their shares would start plummeting. It felt like a game to me.
And still the case, by the way. You look at Netflix, they had less good result for once, and the shares lost 40%. So that's why it is still financial result that drives the world. But you see the WS, they get raided by BaFin, their shares also lose a lot of money. So the reputational risk that comes from having bad governments or having bad environmental policy, etc., is huge also on the share risk. So that's why also it has been taken into account in enterprise value.
Yes, or is it the question of promising something that you don't deliver? In both cases, that's the difficulty, isn't it? And it's very difficult to measure, and this is where I want to get to. Where are we in this journey of being able to introduce these new metrics?
So first of all, there is a confusion between what is ESG and what is impact, and both are very important. So ESG is really about how does a company operates? How is it is environmental policy, how is it is social policy, how is the governance of the company organized? So it's really about good practice, and it's really about, for investors who are looking at risk management, etc. So ESG is really a good gauge of risk management for a company. Impact is about what is the service or the product the company is putting out on the world. So it's obviously, you could say that Tesla, for example, is a company that has a lot of impact because it has changed the way we drive cars and pushing electric car, but is a not so good ESG company because in terms of governance, it is not so well rated. So first of all, there is this confusion between what is impact and what is ESG. ESG is outcome-oriented, impact is outcome-oriented, ESG is income-oriented, in-house oriented. Then for ESG, there is a lot of belief in it. Typically, Matteo Renzi was speaking about nuclear. Nuclear in France is seen as a green energy. Nuclear in Switzerland is seen as the devil. So there is no consensus on what is ESG. And it is a personal value system that will define what you believe is acceptable and what you believe is not acceptable. There's been a very funny story about, I don't know, I found it funny, but it's about credit rating correlation are at around 90%. ESG rating correlation are less than 40%, meaning that if you look at the rating from Morningstar on ESG and you look at the rating from Sustainalytics on ESG, they have nothing together. They don't look
nothing
similar.
In common.
No, nothing in common. So in greenwashing, there is really two problems. Then there's a real serious problem, is if a company doesn't do what they say, and this is perhaps the case of some greenwashing scandals we see today. But then there's also a sort of blurring definition of what is ESG, etc. And perhaps, for example, Unigestion, we believe still in investing in fossil fuel, but we want to engage with these companies in order to make them go toward a transformation. For some clients, this will not be acceptable. So there is also a problem of definition and value proposition that can be acceptable for some and not acceptable for others.
The difficulty is, presumably, making claims that you cannot substantiate.
I think that the important thing is that you have to say what you do and do what you say.
Yeah.
You have to be transparent about what are your beliefs. And then it's the prerogative of the client to decide if he agrees with your point of view or not. And then obviously we do mandate for clients where they come with their view and we adapt their portfolio to their view.
But will we get to a point where there is a very clear landscape, or do you think that we will exist in this mishmash of metrics?
I think we're going to live in this mismatch of metrics for quite a while, but I think it's a great opportunity for investors. Because in fact, financial data has become commoditized. It's very easy. Everybody knows the EBITDA of a company. Everybody knows the revenues of a company. If you want to measure really the sustainable politics of a company, it's much more difficult. You have to dig and do your homework. And this is really an advantage for active management, because obviously you have to do the analysis, and it's more than just buying an index or something like that. So I think that there will still be a mismatch for quite a decade or so, because if you remember financial data, they arrived where they are today in 100 years. And when you were buying stock markets a long time ago, it was not as transparent as today. Now you have the same road with sustainability measures, which are not clearly defined yet and not clearly quantified, but it's a chance for active managers and investors to find the opportunity. One has to see sustainability like a sort of global industrial revolution. So you will really have to understand what are the triggers in each sectors that will make a company profitable or not, because obviously there will be good investment and bad investment, and that's the role of an investor.
I think the triggers in each sector, I think that's a very interesting thought there, and I just wondered if you had examples of that.
So I'll speak about public companies and private companies. So for example, in private companies, we invested in a company which does go-karts, not a green company, obviously, because it's all about driving, but and we engage with that company. And this company has understood that they will create value, and obviously the goal of that company at one point is to be sold to another company. They will create value if they change their go-kart into electric cars. And they didn't do it because of belief of ESG or whatever, that ESG is good, but they just did it because of belief that this will make their valuation go up.
Do you agree with that assessment?
Yes, clearly. Another company in the private space we invested is a company that does nursing, which is called Kindred. Also, they review the ESG policy.
Sorry, what do they do?
They do nursing,
Nursing, okay. Yeah.
And what they do is they review the hiring and the social politics, etc., because they realize that, and then they asked for a label from the government, because they realize that if they have a good scoring from the government in terms of regulation, etc., this will create trust with the parents that give their children, and they will have a growth which is higher than that. So typically, these two examples in the private equity space, where companies have understood that by integrating ESG criteria in their business model, they will create value on the long term. In the public space, for example, I can give you two examples. You see, for example, there are companies, even in the fossil fuel, which has adapted very different strategies. When Matteo Renzi was discussing about the November meetings and every promise which was done about climate, you have to realize today that 80% of companies have pledged to be carbon neutral in 2050. And there's an association which is called Climate 100, which measures how far are these companies, the 100 plus polluters in the world, in regards to these pledges. And I think the role of an active manager is to study these and understand how far the one company is, or how good a company is. And for example, in the fossil fuel, if you look at BP, for example, it's a much better example of a fossil fuel company which is leading a transformation toward being a source of energy which will be partly fossil and partly more clean. But if you look at Exxon, in comparison, it's a company that hasn't gone nowhere in terms of advancing on its climate agenda. You could imagine that with everything that's happening in the world at one point, there will be some regulation that will be very, very severe, and that will have an influence on the price of the stock. So these are examples of companies that have understood how to go into this transition, in this new revolution.
When you look at companies which are listed on stock exchanges and stuff, do you have a vision of how many of them have made these types of adjustments? Do you think it's very widespread, or do you think we have a long way to go?
We have a long way to go. There is a statistic that says that if you look at the MSCI world, the temperature trajectory of the MSCI world today is still 4%. So it means that in average, companies which are in indices have a temperature trajectory which is very far, although they have pledged to the 1.5 degrees, very far from what they have pledged. So there is really a role for the analyst to understand which are the companies which are advancing at a good speed and which are the companies which are not. But I also give you another example. Cement. Cement is a quite polluting industry, but we all need cement. Cement, I think, is the second commodity that is used in the world after water. Obviously, so saying, okay, we want to be a green planet and we don't want to use cement doesn't look very plausible. A lot of people want to build new houses. But you see companies like Lafarge working very hardly into transforming the way they produce cement in a much more alternative way, an acceptable way. If they manage to do it, and if their research is successful, they will have a huge competitive advantage compared to other companies in the same sector. So it's a bit about relative value in the public space, understanding the one that will manage this transition, because you have to see the public space more like the old economy, and the private space more like the private equity, like the new economy. So the public equity will need to transform into that journey. And the role of an active manager will be to understand the companies which will be able to transform.
I don't know what your experience is of how sensitive investors generally are to this, but do you think there is work to be done in communicating amongst the investor community that this is how they need to start to think? Do you think there's more work to be done there?
I think there's different people, different kind of clients in different regions. So for example, we have the chance to have different kind of clients, from family offices to local authorities to endowment. I think endowment are under pressure from their students to adapt their portfolio to the belief of their students. And you can see that there is more and more endowment that start to say, we are okay with investing in this, we are not okay with investing in this. And there's more and more endowment which have a pocket in their asset allocation, which is called impact, where they will invest on product and solution that has a positive influence on the world. Other example which I found interesting is we manage money for local authorities in the UK. And the UK is facing already some consequences of global warming with some floods. And the local authorities have to define some strategies of what they will do with their population if there is a flood. Where will they put them to live if the house is not available anymore? So for them, it's not possible to have a portfolio which is not aligned with climate transition, while they are still in their day-to-day life dealing with the problem of climate warming already. When you look at family office, and it's quite funny, when you speak with entrepreneurs, is they have this view is that put the money at work. And the idea that they don't want only to put the money at work to have a financial return, but put the money at work to have an impact. And they want to be able to measure it. And it's a very entrepreneurial mindset that you don't necessarily see in the institutional, because it's the idea, okay, I have this money, I want to optimize it, not only for return, but also for impact. How do I do that?
Do you think that this type of approach to investing means that you have to expect lower profits?
No, I think it's naive to think that because you see some studies sometimes that say you can invest doing good and doing well. That is naive, and I don't believe in that. I think, like everything, we are facing a huge phase of disruption because of climate change, because of inequality, because the risk of demography, because the risk of immigration. Where we will need to build a system which is more inclusive and that fights environmental. So it's a huge disruption for the economy. It's a huge disruption for financial market. There will be companies which will be successful. There will be projects that will be hugely successful. And there will be companies that will disappear because the activity will be obsolete, or they will have stranded assets, etc., etc. So it is not necessarily a source of performance, but there will be a huge disparity in performance between projects and companies. And if you do well your job, you should be able to find the companies that will profit from this transition, which is going to be massive.
Yes, and because I'm always interested in tips, you've talked about this as an industrial revolution, and I think that's an excellent way of putting it. Are there sectors that we need to look at closely, do you think, that will be, or is it really just affecting almost every sector?
Like, just if you look at climate change, and it's one trend, and you could speak about biodiversity, you could speak about inequality, climate change will change. It's not just about putting solar panel on your roof or driving an electric car. It will be the way we produce food. It will be the way we build houses. It will be the way people consume. It will be the way people move. Do they take more the train, less the train? So every sector at the end will be touched. Investment, asset management industry, our industry, for example, our fiduciary duty is evolving. At one point it was, and in Europe, in the US not, but the fiduciary duty in Europe, the definition is evolving, because at the end it was a bit like shareholder. Our role was to serve the end client, but now we start to have also a sort of social responsibility toward how we channel flows towards project and how we engage with companies who we invest in. So it is really not just one sector, one company that's going to be touched. You have to see it as a global industrial revolution that will touch every sector, and that there will be companies and projects that will manage this transition, and there will be those that will not. And our role as investors is to invest in the first ones.
Excellent. Well, I think that's a good moment to turn it over to the audience. If anybody has any questions, straight up, the lady in red over there. If you keep your hand up. Oh, they were wearing red. We could probably see you, identify you quite well. If you'd like to say your name and where you're from, please.
Sure. Maria Kindness from Impactus Partners, who are impact investors. And I like what Fiona was saying in regards to ESG versus impact. Yeah. And digging deeper into that, when you compare, for example, an oil major versus a wind turbine manufacturer, very often the oil major, for example, or the utility scores higher in ESG. But what about the replacement effect? What about indirect exposure? How do you view that?
So in impact, they will score badly, because what they produce, obviously, if it's mainly about fossil fuel, they will score badly. So if you do, obviously, a portfolio which is impact-related, you will be underweight or not at all invested in that sectors. But on ESG, they can score better because they have a good policy in-house about how they treat employees. But for example, for fossil fuel, the view we have is that companies that produce energy has a huge capital base. if they can just allocate differently their capital by allocating more to research, to alternative, this is all the money that can be deviated towards going to alternative source of energy. So, for example, we are not in the camp where we say we want to ban fossil fuel companies of our portfolio. We want to invest in the good ones and engage with them, because obviously we are shareholders. The beauty is that there exists now some collaborative engagement between asset managers, where we put all our shares together, and then we vote similarly at the General Assembly. We want to engage for them to evolve toward allocating more money, and they have huge pot of money, toward new products, which are more alternative.
Good. Any other questions? Yes, please. Over there. If you keep your hand up, lovely, thanks.
I'm Karen Wilson with the OECD, and we also co-chair the Impact Management Platform, which is a collaboration of 17 standard-setting organizations around the world. I wanted to come back to your point about policy and ask you about the role of policy. Obviously, it's moving at different paces in Europe and the US and also internationally. And with the creation of the International Sustainability Standards Board, obviously, that's great that we can have international standards, but can you talk a little bit about the role that that will play also in driving the behavior of companies and investors? Thank you.
So I think, in the International Sustainable Standard Board is a very, very important development. At the end, it's a way to quantify and to measure externalities such as climate, environmental, biodiversity, and put it in the annual account of a company. When this will be finished, it will have a huge impact. If you look, for example, even on companies which says they include the carbon pricing of their pollution in their annual report and in the profit loss account, the average price of carbon pollution is $4. If you look at, for example, at European price, it's $90. So if we could have a system of policy which forces every company to disclose in the same way their externalities they have on the planet, because obviously the planet doesn't send the bill, but if there is a overall way of measuring which is regulated, that will make things very, very, it will be very important, and there will be some huge valuation change in companies, because some companies have not priced that in their P&L. So we look forward for that. I would say that for the moment, it's still very voluntary on companies on if they want to include these externalities in their P&L and how they want to include these externalities. When there will be a standard, that will be much help.
I'm getting a picture of a sort of profile of investment that is different. Do you know what I mean? That if people were thinking about quarterly earnings or things before, you might look more for capital growth, or you might look over a different time frame. Is that a good way of thinking about it?
I think when you look at sustainability, obviously you look at a bigger time frame, but at one point, if ESSB goes forward, your net profit for company will not be the same net profit from the end, because you will have some indirect external cost which will have to be taken into account. So there will not be ESG discussion and financial discussion, because ESG will have entered the P&L account.
Yes.
So there will be financial discussion taking into account the externalities of the company is doing on society in their account. So
Yeah.
it will be quite massive.